Hi, everyone. We're joined today by Kelebogile Moloko, who is the founder and chief investment officer at Prowess Investment Managers. How are you, Kelebogile?
I'm very good. Thank you, Natalie.
Excellent. Thank you for joining us today and taking the time to meet with us. Kelebogile is going to talk to us about impact investing and private markets. So thank you, Kelebogile. Would you like to make any initial thoughts, or are you happy to jump straight into the questions?
Yeah, I think this is a very crucial, topic, particularly given where we are as an economy, as a country, but also just globally. And it's a very important investment theme. So I'm excited to get into it.
Thank you. Thank you for spending some time with us today. I guess the first question for a trustee would be, what is impact investing and how is it different from traditional investing?
Yeah, so impact investing, refers to an investing strategy that includes positive and measurable social and environmental aspects, right? So it's looking at investment strategy, saying, okay, fine. Traditional investing looks at achieving financial returns. Obviously, there's a method to it. You're looking at risk management, but then you have an intention of, capital growth and, wealth creation. Then when you come to impact investing, it overlays the traditional investing with specific socio-economic outcomes or environmental outcomes. For example, I might want to invest in infrastructure because, it actually positively affects economic growth. So that will be an example of impact investing. So the financial returns and the social returns or environmental returns should not be mutually exclusive. So they can coexist in an impact strategy. And then also, it's important to realize that impact investing can take the same form in terms of the asset classes that you target, similar to traditional investing, right? So you can invest in equities or private equity, which is unlisted, or listed bonds or private debt. You can invest in the listed property market, or it can be unlisted property market. So it mirrors the traditional investing principle also from an asset class perspective. But the core difference being that the investor has got a personal goals or societal goals that focus on doing good over and above social returns, rather financial returns.
I'm so glad you mentioned the word private equity and private debt. I work with a lot of boards of trustees, and many a time the words impact investing, private equity markets, social impact are all kind of intertwined into one conversation. So what exactly is private markets?
So private markets is simply investing in securities or instruments or asset classes that are not publicly traded. So meaning that they are not listed on a stock exchange like the JSE or the Nasdaq or the London Stock Exchange, right? So the key differentiator is that public markets will be listed. The pricing is available intraday and at end of day. So there's transparency in terms of trading and pricing. And then private markets is actually unlisted instruments or unlisted investment strategies. It's as simple as that.
Sure, but when I hear words like unlisted, my mind immediately goes to things like unregulated or unsupervised. So what would your comments be around a trustee who sees the word unlisted and goes, I'm a little bit nervous of these types of investments?
Yeah, I don't think trustees should be necessarily nervous, but it's the right question to ask, right? It's like, how is it different from a regulatory perspective, to a listed instrument or investment opportunity? I think it's very important to realize that obviously retirement funds would have to make investment decisions within the, pension fund regulations. You also have Regulation 28, which is there to actually, give a risk return framework of how pension funds should actually invest. So you would find within Regulation 28 that there is allowance for, public markets instruments and private markets instruments. For example, in Regulation 28, you can invest up to 15% in a combination of hedge funds, which are generally also referred to alternative assets, private equity or other assets. But your private equity, which is an unlisted, asset class, the maximum is around 10%, right? You also find that within Regulation 28, you can invest in debt, government bonds or corporate bonds and so forth, listed or unlisted, but the combination of your entire unlisted universe for a pension fund should not exceed 15%. So already it means that there is room and scope for pension funds to invest in unlisted assets. But then it becomes important in terms of how those unlisted assets are actually evaluated before they're included in an investment strategy, and how they are monitored and how they are managed from a risk perspective. So you would find generally that unlisted or private markets, we can use that interchangeably, that there would be a liquidity premium. Those assets are not easily tradable, right? So the liquidity risk is higher than a traded or a liquid instrument listed on the JSE. So when you are investing in a private market or unlisted asset, then you need to take that into account to say, okay, fine, am I willing to actually live with this asset until it actually matures, that I'm not going to have cash flows? Does it actually suit the profile of the investment strategy that I have in place? The second aspect as well is that you would find that a lot of the listed instruments or listed strategies, they are more standard and uniform in terms of how they're structured. You're investing in an ordinary share of, Barlow World versus, First Rand, different industries, different macroeconomic factors, but then it's structured in a similar way. It's an equity ordinary share, so you understand how that works. In the private market space, that is the case, but every instrument or every investment will be nuanced depending on what you're trying to achieve through that particular investment. So there's a bit of structuring that can be involved. The legal agreements that actually express the terms and covenants of your rights to the investment will also be very specific and customized, right? There might be other regulatory requirements or governance structures that you actually embed within a private markets or unlisted instrument as well, which can give you even better controls and enhancement than a listed instrument. And there's also opportunity to earn higher returns as well, using a private markets or unlisted instrument. So I would say don't shy away from it. Don't be concerned, rather be informed and understand the differences, and then have sufficient advice from different stakeholders before making a decision for your fund.
I mean, just thinking off the top of my head, if I was a trustee who was wanting to get involved in impact investing, can I only access that through private markets?
The answer is no, actually, because there are different types of impact investing. I think when, years ago, when I started in the industry, I think the buzzword was, socially responsible investing, right? And these terms are used interchangeably, but it's just to understand. So back then, it was a matter of, you could look maybe at the all-share index, right? And say within the constituencies of the all-share index, I'm going to exclude, companies that are invested in certain industries, and normally they would be called sin industries, right? Like tobacco, gambling, and so forth, or whatever. Or which is then referred to negative screening in terms of social responsible investing theme. Or I could say I only want to include companies that have a positive aspect to their business dealings and so forth, which is then termed positive screening. So that can be available in the listed market and also in the private markets, but more dominant, obviously, in the listed market as well. Then you have what we call ESG investing, environmental, social and governance factors that are now incorporated in your investment analysis when you're looking at a specific company. So that looks at the business strategy and management. How do they, deal with the environment within which they operate, right? How do they reward their employees and the work environment that they generate and social aspects that are key to their workforce? Governance, which is how's the board structured, and management and inclusion, and diversity, equity, and inclusion is another strategy within that context. And do they have the right governance according to King, right? So you look at that as well. So you could also say, okay, fine, in my impact investing strategy that I target as a trustee or as a fund, these aspects are important, and I want to make sure that all of the investee companies that I'm invested in have got a specific minimum standard that they actually meet, right? And then you have impact investing in its true form, where you are now targeting companies that either provide a service or sell a product that will bring about socio-economic change. I mean, examples would be investing in infrastructure because you want to build roads, right? Or access to education or healthcare. So those will be much more impactful, hardcore, because they're looking at the end service or the end product. And those strategies are the ones that are predominantly used to then revitalize economic growth, right? And to close gaps that might exist in terms of certain basic requirements that a country requires in terms of access by its citizens.
Mm. Okay, so there's a number of ways to get involved in impact investing. How do you go about evaluating the investments that you choose to invest in?
Yeah. I think what's very important, obviously, is that you first have you have to have a criteria that you use in terms of the investment strategy that you have. So, for example, if a fund that we're managing is targeting, the renewable space, renewable energy, for example, so already it gives you a criteria that you're not going to look at anything else rather than renewable. So I think it's also important from a fund perspective or trustee perspective to be clear that when you're giving a manager money to manage in an impact investing strategy, you're already clear in terms of what the objectives are. High level objectives, which sectors are included, which sectors are actually excluded, right? And then within that context, obviously the financial aspects are important, because you don't want to give anybody money to manage and you're not able to achieve the financial returns, which also need to be comparable and competitive compared to the traditional markets if the strategy is unlisted. And then second is the impact aspect. So within the impact aspects, it's also very important then to have key performance indicators or measures that align to the impact objective that you're trying to achieve. So if I'm invested in a low income and affordable housing, some of the KPIs might be which geographic region am I targeting, which disposable income level am I targeting, maybe the race or the location of the people. So you can get more into specifics in terms of, the proceeds of the investment that I'm making, or even the company that I'm supporting. Who are they supporting? How? And how can I measure that impact? So it's very important that it's predefined and that it does exist, that you use different data, to be able to gather the data, to analyze it, and to make sure that you can actually have something tangible and measurable, and sort of predictable where possible, to underpin the impact aspect, rather than saying I'm doing something good. It might be greenwashing, which is what, you might think that something is actually doing what is intended, but that's not the case, right? So really getting those tangible, measurable factors in terms of impact then becomes quite important. And within that context, obviously, then it's monitoring the financial and the social or economic impact or environmental aspects, that they actually align with the strategy. And if they don't align, then obviously there's proactive engagement with management or the investee companies, to bring it alongside the core objectives that were set.
I'm so glad you mentioned words like returns and objectives, because I guess any trustee or any investor would be interested in knowing how the returns of an impact investment would differ, or could be expected to differ from that of a traditional investment. What is your experience of that?
Yeah, I think, there's a notion that has existed, a couple of decades ago, but even maybe currently, that sort of kind of like purports that when you invest in an impact investing strategy, then you compromise returns, right?
Mm,
And
mm,
it's not always the case. I think, there's been data that has been collected both globally in global markets, but also in local markets, which actually demonstrates that there are seasons or cycles where impact investing strategies actually outperform, traditional strategies. I think that the principle, the fundamental principle is that when a company embeds doing good in terms of their business strategy, in terms of the ESG factors, or even the products or services that they offer, that net on net, it actually supports the value that they generate, not, also from a financial context. But also when you look at some of the indices, I was looking at international data as well, where you find that impact investing strategies in the listed markets then would outperform, your traditional or non-impact investing, indices or strategies. Also, when you look at the private markets, I mean, I was looking private markets strategies, which is more the unlisted as well. There was a report that I was reading earlier that actually indicates that over 20 years, especially in US global markets, that private equity would actually outperform publicly listed markets as well. Having said that, it's like every strategy, obviously, in impact investing will be slightly nuanced and different. So it's very important that you find the right benchmarks in terms of comparing, traditional or public markets compared to private markets, and also take into account that there might be different times or vintages as you enter into private markets. So depending on what was happening in terms of the economic cycle or factors that actually would inform valuations, that performance might slightly be different. So it's very important just that when you do the analysis that you compare apples to apples as much as possible. But then the two are comparable. And in most instances, you find that impact investing strategies actually hold up quite well against
mm.
public markets. Yeah.
So it's so positive. Um, if I was a trustee wanting to direct fund assets towards the greater good, which is essentially
Yeah.
what we're talking about, um, is there I have this thing in my mind that impact investing is for big funds.
Yeah. Yeah.
Is there an opportunity for smaller funds to get involved in these? Are they pooled type of portfolios or kind of off the shelf impact products that we could invest in?
Yeah, I think it depends on whether you're wanting to go the listed or public markets route or the private markets route, right? So I think there are products in the public markets that would deploy an ESG strategy or responsible investing, like I explained earlier. Obviously, those can be easily available through either a unit trust or retail, strategy where, or a multi-manager type strategy as well, where smaller funds then are able to buy into already existing portfolios that are pooled, where size is not an issue. When you come to private markets as well, there is an opportunity, obviously, because depending on which structure is actually utilized by the manager or the multi-manager or the consultant that's offering private markets, a limited partnership also allows, several investors to be invested, but then there might be minimum thresholds that a fund needs to meet, which then might exclude you. But then you also have fund of funds, which have also been created where you're not the only investor, but also you're not the major investor. So it also allows smaller funds to then participate, because then you're piggybacking of larger retirement funds that are anchoring, the size of a particular fund. So I think it's important that funds actually find out from their consultants or just, products that are available in the market to see, how they can access and access entries as well.
Great segue into my last question, which was, obviously people are interested in becoming more involved in the social good of the investments that they direct. But
Yeah.
how do they even start this conversation? Is it with their consultant in the room, or do they pick up the phone and phone Prowess, for example?
Yeah.
How do you even start this conversation?
Yeah, I think, it starts at the fund level. If I'm a trustee and, I'm hearing this for the first time, I've heard it and I'm not sure, I'll ask the fund first to say, in our investment policy statement, I mean, do we target impact investing strategies? Because even Regulation 28 has a preamble that every fund must consider ESG factors, right, in its investment strategy. And then second, I know that all South Africans, we want a better South Africa that we can all retire comfortably in and be able to, manage the socio-economic imbalances. So what a better way to do that through an impact investing strategy. So a discussion at the fund level, asking the consultant for information of what's available, how can it be done? And there is information available from various consultants. I know that obviously Batseta and IRFA and SAFCA, those institutions, they've got a lot of information. They hold webinars just in terms of informing and educating, trustees on private markets. And then obviously there's asset managers like ourselves as well. But I know that usually some trustees might say maybe our information will be biased because we want to sell products. It's not always the case, because when something is new, it's quite important that as stakeholders that we empower one another, right, with the right information rather than actually putting product selling as a priority. And then you would find that some of the consultants also, they would produce return data in the monthly surveys. So, you can look at that and start actually getting a sense of how do these strategies actually perform relative to traditional markets, and start asking the right questions. And then finally, partner with asset managers that already have strategies that are performing. And some of them, usually they will do, a project tours, because sometimes it's better to touch something. It's not just on paper or something that you've heard. They can take you to a project that they have done, either investing in hospitals or low income and affordable housing or student accommodation and so forth. And then you can see what the ultimate product looks like and how it was structured, because then that also gives you a better sense. It's not hearsay. You've actually seen, you've asked the right questions. But it's a journey. It starts with taking the first step of being informed, being curious, gathering information, and eventually getting to a point where you can actually maybe put out an RFP where managers are able to come for a pitch and you can deploy capital.
Stunning. Thank you so much, Kelebogile, for joining us. This is the first of a number of interviews with Prowess, and I think has set the scene for a lovely conversation going forward. Thank you.
No, thank you so much, Natalie, for having me. I quite enjoyed this. You're welcome.